When critical supply routes like the Strait of Hormuz are threatened or closed, global trade halts. 20 million barrels of oil flow through that specific choke point every single day. A disruption there creates an immediate mathematical problem. Global oil prices spike. Because oil is priced in dollars, foreign nations caught in the supply shock suddenly need massive amounts of U.S. currency to keep their economies running. This chart measures America's net international investment position. During past Gulf Wars, it was -7%. Today, it's -87%. Foreign nations hold $70 trillion in U.S. assets. To get dollars in a hurry, they dump their U.S. Treasury bonds. A distant geopolitical conflict triggers a mechanical, forced sell-off of American debt. It creates a vulnerability the United States cannot control. When foreign governments flood the market with U.S. Treasuries, the yields on those bonds go up. The yield is simply the interest rate the U.S. government pays to whoever holds the debt. Economists track a specific danger zone for the 10-year Treasury yield. When that rate climbs into the 4.6 to 4.8% range, borrowing becomes too expensive for American businesses and consumers to maintain normal operations. This flowchart visualizes a debt-death spiral. Higher borrowing costs force bigger deficits. To cover them, the government borrows more, pushing interest rates higher. Applied to a $40 trillion national debt, the interest payments compound so rapidly that the math becomes entirely unsustainable. This math problem corners the U.S. government. The acceleration of the debt forces the Federal Reserve to intervene immediately to prevent a complete default. Central planners looking at this spiral have exactly 3 options on the table. Every single one comes with heavy consequences. Option 1 is to do nothing. Let the bond market naturally push yields to 5 or 6%. Investors pull their money out of the stock market to take the guaranteed high interest rate. That drains consumer spending, craters tax revenues, and guarantees a severe domestic recession. Option 3 is to walk away from the global conflict and let the supply chains sort themselves out. But retreating signals to the rest of the world that the U.S. cannot protect international shipping, accelerating the push by foreign nations to trade oil outside of the U.S. dollar system entirely. Which leaves option 2, the path they are most likely to take. The Federal Reserve will step in. They will execute Type 2 quantitative easing, printing massive amounts of money to buy up the Treasury bonds and artificially force the interest rates back down. During the 2008 bank bailouts, printed money mostly stayed trapped inside failing financial institutions. But Type 2 QE drops new cash into the accounts of non-banks and regular institutions, injecting fresh liquidity while the world is simultaneously experiencing an oil shortage pushes consumer prices upward rapidly. Printing money delays the immediate default, but it trades that problem for severe double-digit stagflation. To survive the long-term cost of that inflation, the state is forced to find a massive, permanent new buyer to absorb its debt. The long-term solution requires distributing that debt to a new base. The government plans to privatize the liability and upload it directly to the global population. This architecture is actively moving through Congress right now. Legislation like the Genius Act mandates that any company issuing a stablecoin, a digital asset pegged to the U.S. dollar, must act at 1-for-1 with actual U.S. treasuries. The cryptocurrency company Tether has already tested this model. Today, they hold over $120 billion in U.S. treasuries to back their digital tokens. They're one of the largest holders of U.S. government debt on the planet, serving as a highly successful proof of concept. Soon, major corporations like Tesla, Apple, and Amazon will roll out their own digital wallets. You load your dollars into their app, the corporation uses your cash to buy U.S. Treasury bonds, and they pass a fraction of the interest back to you in the form of charging credits, product discounts, or digital yield. By leveraging the brand loyalty and daily utility of the apps you already use, central planners turn 8 billion smartphones into a massive decentralized sponge. Everyday citizens absorb the national debt without ever realizing it. This new financial system is arriving at the exact same time as a second massive crisis. Artificial intelligence and automation are rapidly displacing human jobs. As this infographic details, the incoming architecture solves both problems simultaneously. An AI-driven economy generates massive corporate profits, which filter into citizen digital wallets backed by U.S. treasuries. It provides the exact distribution network required for a universal basic income while funding the government's debt. But streamlining society's finances this way introduces fully programmable money. Private issuers like Tether have already proven they can freeze wallets and sanction specific addresses with a single line of code. Expanding this capability to everyday corporate apps creates a financial dragnet vastly more precise and far more restrictive than the international SWIFT banking system. The design of this new global control grid relies entirely on consent. Citizens willingly trade their financial privacy and autonomy in exchange for a clean user interface and a 5% yield. Operating successfully outside of this digital grid requires specific preparation. Historically, governments rewrite the rules to protect themselves during acute economic crises. In 1933, President Roosevelt issued an executive order making it a criminal offense for American citizens to hold physical gold, forcing them to sell it to the state. Protecting your purchasing power means securing hard, physical assets that you custody yourself. An asset held directly in your own hands cannot be monitored by an algorithmic digital wallet, nor can it be disabled by a remote server. By tracking the massive acceleration in the national debt and measuring it against the rise of automated productivity, you can clearly see the blueprint for the next financial system. Recognizing those specific mechanisms gives you the time to properly position your wealth before the exits are closed.